Can I please ask you to take your seats? Please ask you to take for the rushed lunch, but I greatly appreciate the effort to be back here almost on time. Muchas gracias.
Our next speaker requires no introduction, and it's a great honor for me to welcome him here today. Again, an amazing leader, one of the main contributors to our country's transition and the European construction. He was president of the Spanish government from 1982 to 1996, years in which he was able to contribute to the modernization of Spain and to bridging the gap with European democracies. During his presidency, Spain joined the EU, an essential step in the consolidation of the country as an open, fully integrated country in the world, providing universal health care and a universal pension system were some of his government's achievements. He's going to share with us his views on Europe at a time when we clearly need a vision like his. Thank you, President.
Muchas gracias.
Thank you very much. Thank you for inviting me to take part in this conference, particularly with Fernando Enrique Cardoso. We've been friends for 40 years. By the way, since I had a brief but very precise introduction, you have nothing to fear. It was 22 and a half years that I left government, as you've seen. So there's no threat for anybody. And I'm asked to speak about Europe. And I always have a difficulty because, of course, I am very pro-European. And I believe in European integration. But when I speak critically about Europe, in the best way possible, people always conclude that I'm a pessimist. Because it seems that us pro-Europeans can only say good things about a Europe and never criticize those things that don't work so they can be improved. Because they're worried that Eurosceptics will take advantage of that. And I don't think that's correct. I think if we didn't have the European Union, we would have to come up with something pretty similar in order to represent something in this globalized world we live in. If we had a map here of Europe, you would see that it is just a small southwestern corner of Eurasia, with maybe 6% of the world's population in just a very short time. And so if 6% of the global population, and a very aged one at that, so 6% of the population, unless we stand together and if we allow ourselves to be divided, you can imagine what tiny role we'll be able to play in the global economy and in this globalized world, even though there is a lot of mistrust of globalization, which is the result of an accelerated and unstoppable technology revolution, which has revolutionized, as Fernando Enrique said before, which has revolutionized communication between human beings, and by revolutionizing communications has revolutionized everything. So that's not reversible. We might find it frightening and come up with proposals, as Fernando Enrique said, that might be regressive utopias. I would love Great Britain to go back to the Great Britain of the 60s, of the last century. Great. Or the US, or Spain. Well, not Spain, maybe, not back to then. But I would like to go back to that, because I don't like today, and I don't like the threats of the future. That's what Fernando Enrique calls those regressive utopias. And so what's happening to us Europeans is we're questioning the existence of the European Union. Brexit is just a small example, or a big example of that. We are really questioning the existence of the European Union, or are we thinking about the reforms that Europe needs in order to face the challenges of the future? Because it's generally said that we live in a time of great uncertainty. because of the very fast changes we are experiencing, because of the impact of changing technology. Things that happened in the past, but of course at a much faster speed, like the Industrial Revolution, now the Technology Revolution, which is bringing on a new era. And we feel like we're running behind the future, which has already happened, which sometimes gives me a bit of anxiety here in Spain, because it's as if we're chasing a future that's already behind us and not the one that is ahead of us. But I would like the vision of somebody my age who's never lost his curiosity and who is never willing to resign. Uncertainty is not about what's going to happen. That's actually the only certainty. The only certainty is that artificial intelligence is what it is and it will continue to be. Biotechnology is what it is. The ICT revolution will continue to speed up. Automation, robots, whatever you like. All of those things are already facts. And they are here and will just speed up. And so that's actually certainty about the future. What is uncertain, and that we see in the political debate we're immersed in, is whether there will be adequate governance in order to move towards that horizon. Discussing those challenges, maximizing the opportunities and the benefits, and minimizing the risks. And so uncertainty lies more in the governance of the process than in the process itself. And that's what worries me about the European Union. A while ago, I was talking over lunch. Somebody asked me some years ago, Europe, will it become a museum or a laboratory? And well, since the Renaissance on, it's always been a great laboratory. The Industrial Revolution in the 18th, 19th centuries, it was a great laboratory of research and ideas, which then disseminated all over the world. But right now, is it a museum or is it a lab? It is the most wonderful museum you can enjoy, and of course it has to be preserved. But will we be resigned to be just the museum for the new economic powers of the world? And will we give up on being this lab originating new ideas? That's my concern, which is interesting because that shouldn't be my concern. It should be the concern of those who are currently in charge, 40 years old or so. That's when I started leading a government. Not in politics, I was there at a younger age. But we're really focused more on discussing the problems of the past than those of the future. And when we're not talking about the problems of the future and talking more about the problems of the past, we are seeing an increasing polarization of society, which is one of the effects of what's happening. And that's doing away with the space where great consensus can be built in order to deal with common shared interests, the challenges of the present and the future. And we're seeing this polarization, this increasing division in every society, and we're seeing it in Europe. And so when I'm asked that question, I say, no, we cannot give up on being a lab for new ideas. But we should also enjoy being a museum. Why not, when we have this incredible artistic and cultural heritage? Now, of course, I don't want to spoil your lunch. It was quite a light lunch, I have to say. It wasn't that heavy a lunch, but since I don't want to spoil your digestions, I'll be brief. There's a European crisis. Yes, there has been a succession of crises. Just to give you a bit of context, in the last decade, there was the 2008 crisis. From 2008 till 2018, in the hardest hit countries, we're saying the crisis is now behind us, but I'd like to remind all of you that the social consequences of the crisis are not behind us. We still have a lot of social consequences. If you look at our GDP in real terms 10 years ago and 10 years later, the figures we have, okay, yeah, we're back at the same GDP level we had 10 years ago, which means that if it had remained flat, that would have been 10 years with no growth, which would have been hard enough, but it's not a flat line. It's a big dip, and in that big dip, there were various circumstances in terms of impacts of the crisis, depending on which segment of the population you're in. And so when the President of the Commission told me in a recent discussion, and we're very good friends, that we still have the scars of the crisis, I said, no, we still have some open wounds of the crisis, because Europe came up with a concept which some later felt was a hindrance, which was the social market economy. And that was one of the great European contributions to world civilization. Earlier I heard talk about corporate social responsibility and sustainability in the panel before Fernando Enrique Cardoso's speech, and said Europe came up with this concept of the social market economy, and then it felt that the social dimension of the market economy was a hindrance to competitiveness. And now, if you will allow me, they're reminding us from Davos for the last 4 years that there are sustainability problems with the economic model of globalization, because wealth redistribution is too uneven. Not just when the economy is growing, but particularly when it's not. And that is causing sustainability issues. So we already had the concept, and now, in part, we have forgotten it because we believe that it was a hindrance to compete in the global economy. But this is not something I'm saying in ethical or moral terms. It's about future sustainability of the economy. And so I am, if some of you might want to criticize this, others you can't criticize because they're gone, but I was one of the signatories of the Treaty of the European Union and the Treaty for Economic and Monetary Union. And I have to remind you of some historical context. We were debating the Union Treaty as another step towards integration, sponsored then by Jacques Delors, who was and still is a compulsive Christian who resigned often from his presidency of the Commission when he couldn't get them to approve what he was proposing, particularly the budget. But then we would persuade him to stay on. But anyway, he did give a big boost to the Union and went a step further. But then look at what happened so you can understand some of the problems. In that transition, as we were discussing 12 and then 15 countries were discussing a step further in European integration. European integration was a completely new model which cannot be defined in any way. It's a model of integration which means yielding sovereignty in order to share it with the others. Not for the others to use it, but to share it with the others. And so the point when we were discussing the treaty, the Berlin Wall came tumbling down and the Soviet Union collapsed. And the countries of Central and Eastern Europe were released from the yoke they were under for so long. And their very first aspiration was NATO. Let's not be too optimistic here. It was about common defense. But their second aspiration was joining the EU. And so there we were, debating the treaty with the 15 at the end of my mandate. And all of a sudden, we started to discuss about whether to enlarge or to deepen the union. So it was extension or deepening the union. And they tried to do both, because both were needed. But it got complicated. There were some cultural differences. But eventually it was signed, and I was a signatory to the Treaty for Monetary and Economic Union. I welcomed the euro. And we did warn, together with the Delors Foundation, amongst others, that you couldn't have monetary union while forgetting that the treaty also referred to the economic and monetary union, because that would mean, with a single currency and therefore a single monetary policy, that there would be asymmetric shocks in case of a crisis. And so what I'm saying is that there's a problem we still have to solve, which is a structural problem and which is going to be hard to solve. The US experienced it for decades until their monetary policy became imbued with solidarity. Otherwise, such an admirable and fantastic state like California could not have been financed if it didn't have the support of the Federal Reserve. It would have been the wealthiest and technologically most advanced failed state in the world. But thanks to the Fed, it is able to finance its debt and its deficit. And so there's a structural problem that we have been speaking about. I was entrusted with speaking about the future of Europe from 2009 and 2010. We produced a report, and one of the elements in that report was that one. You can't have governance of the monetary union until we fulfill the original concept of the treaty, no matter how difficult it might be, which was economic and monetary union. So we really need to have a lot more fiscal harmonization for the monetary policy to work. And so the first crisis was that of 2008. We had structural problems, and then there have been some various attempts, which were not, in my view, the appropriate ones. I would have preferred counter-cyclic policies without losing sight of the need for balances, as they did with the two Obama mandates. So I'm not speaking about any revolution, instead of resorting, and rather late, to just monetary policies. And then there was the immigration crisis. And what really worries me, it's not that immigration policies were unsuccessful, or that we live with the contradiction of needing in Europe 50 million immigrants for the next 40 years in order to sustain a reasonable demographic pyramid. What really worries me is that I cannot criticize the immigration policies of the Union because there isn't one. I'm not sure whether there's a good or a bad one because there isn't one. And so we have a common border, whether we like it or not, and that's had serious consequences because in Italy, this reaction has not come out of nowhere. Italy had to bolster a border against tremendous immigration pressures while the rest of Europe pretended for years that it was Italy's problem when we have a single border and the Schengen area and freedom of movement for people. So we really need to rebuild a serious joint immigration policy. We don't just need it. It should be a lot less serious. And this is a bit of an advert for us than it would be for Colombia to receive, in this biblical exodus, fleeing Venezuela's tyranny, 1.5 million Venezuelans crossing their borders with nothing. For Colombia, which is a country about our size, and of course with per capita GDP that is somewhat lower than ours, it's maybe a third of ours. So really we have to understand the size of the problem. Europe's response has been non-existent. And because I don't like to be critical without offering alternative solutions, there's only one mechanism, which is reinforced cooperation between any group of countries that agree. And those who don't want to be part of that immigration policy that might be defined, whatever it might be, with the necessary controls and so on, and those who don't want to be part of it should not then request structural solidarity from the EU for their needs. And so there has to be reciprocity. And the third challenge, of course, is Brexit crisis. It still is. We are at a very difficult point, and I hope for a good outcome. And there are some difficulties, some very clear, others which underlie the more obvious difficulties, including a referendum that was held, some speak about a second referendum or not, but it was really difficult to explain the first referendum, and it would be even more difficult to explain that you're going to do another one. Because out of a non-existent explanation, you can't set up a second referendum for an even more difficult explanation. I'm not saying whether it was convenient or not, or advisable or not, but of course in politics you learn, and when you get it wrong, you try and avoid repeating your mistakes. But it is difficult to manage this crisis. Why? Because Europe, where I'm so often asked, the two-speed Europe or the three-speed Europe, there were always different speeds in Europe, at least since I sat in the council, always. And it wasn't just about different speeds. They also spoke about concentric circles. But they're not really concentric circles either. Sometimes these are circles that overlap in some responsibilities and not in others, and that's harder to manage. But that's always been the case. Having different speeds is not a worry for me. What is a worry is to close the door on anyone that might want to join at a greater speed. But otherwise, it's not a problem. It might be difficult to manage, but it's just that. And now we have this crisis glimpsing in the horizon, which is the relationship with the US in general, and more specifically, our relationship with the Trump administration and its unpredictability. And therefore, their vision, well, actually, I wouldn't call it a vision, their perception of Europe, which is that Europe should not exist as such. In some countries, particularly, he dislikes. And so it is something that's difficult to manage, definitely. The North Atlantic, I'm not even saying transatlantic relationship, because we've often tried to establish a triangular relationship with the rest of the Americas, so that the South could also be part of this Europe-America relationship. And I'd remind Fernando Enrique Cardoso that we really should conclude the Mercosur-EU negotiations. It would be the first time that there would be a regional treaty. And the only obstacles are perfectly possible to overcome based on our shared interests. It's about selling a few more avocados here and there. It's nothing that's impossible to manage. But then I think it's something that would be of extraordinary mutual benefit. But anyway, so we have these 4 threats or challenges. But what really worries me right now in the European context, Merkel has certainly been weakened. The European construction was always a process which required France and Germany to communicate and partner. And that, of course, is necessary, but not sufficient. You need a lot more countries on board for things to happen. But it is still a necessary condition. Macron is finding it difficult to see what's going on, because Merkel has decided not to lead her party anymore and not to be a candidate anymore. And there's 2 ways to use that clear weakness. They probably will continue to lose elections until the end of the mandate, but there are 2 ways to deal with it. The natural way, which is to accept the relative loss of power, which might bring into question the CDU-CSU coalition, SPD coalition. So that it might be brought into question. In fact, already is after the last 2 elections. But there's another way to manage it, and it's not going to happen because it would be an unexpected but positive reaction, which would be to say, okay, since nothing is at stake anymore, I'm going to do what's needed to overcome the European crisis. But of course, you can't expect that from someone who's decided that they've been struggling for too many years. I can assure you that over 10 years running a government these days is something that is almost unbearable. It's beyond human strength. I really mean it. When I lost the elections, I had been in office for 13 and a half years, and I told Fidel Castro, I can't even stand myself anymore. You can imagine what my citizens feel. And that's just the way it is. I told him in November 95 in Bariloche, when we were trying to fix the relationship between the EU and Cuba, and I'm sure you like the whole story. And he stood up because he thought I was criticizing him. Because I had elections in March, and I said, I'm sure I'm going to lose them, so you have one last opportunity to reach an agreement with us, because I am actually really dying to step down. And he said, do you think I'm here out of pleasure that I don't step down? I sacrificed myself for Cuba and the revolution. And he started coming out with the usual grandma speech, addressing me. And I said, well, don't worry, sit down and let grandma publish it tomorrow. But if your sacrifice is that unbearable, why don't you ask Cubans whether they really need you to continue to sacrifice for them, or whether you should get a vacation.
Y tampoco creo.
And of course he didn't like that either. So, I'm always asked the same question. More Europe, less Europe, liquidate Europe. The problem's not a quantitative one. Believe me, it's not about more or less Europe. We just need better Europe. And you, of course, meet in this context, and I'm sure will understand what I'm going to say, which I repeat often. There's none of the big complex corporates has been able to withstand the last 60 years simply by accumulating knowledge without updating itself or restructuring itself. There's no complex corporate or institution that can stay immobile. Some have outsourced things, have carved out things, have gone into new sectors. They've had to adapt and change. And Europe, of course, has an acquis which was initially, of course, built by accumulation. When we agreed on something, we made it part of the acquis and so on and so forth. And right now, the Union's architecture is no longer about accumulating shared consensus. Now it's more about urban planning. What do we need to have in the center? What can we return to the periphery of the Union? How can we unload some of this inefficient bureaucracy? Not because there's that much. Paris City Council actually has more functionaries than the EU. It's not that it has that cumbersome a structure. But you do need to review what we truly need. And I've already said that we do need some structural reforms in order to improve the governance and have economic and monetary union. We can't continue with the single currency with such divergence economic policies that will cause the asymmetric shocks we've suffered in 2010, 2011. We need to correct that, and that's going to mean a big boost. But what I would ask the new generation of leaders in my country and in Europe is, instead of coming up with problems we don't actually have to discuss and creating more division by criticizing, insulting, instead of appreciating and valuing, that they should start discussing how to govern the transition, which is inevitable, between our society today with the economy we have and the conditions we have, and the society that is to come, whether we like it or not. And by the way, I like it. What I don't like is that it might run us over if we don't start thinking about the future and overcome these regressive utopias and this longing for the past. I hear a lot of people, ideologically pretty close to me, suggesting that we have to go back to the 60s of the 20th century, to whatever you feel was your golden age. That's a big mistake. Europe is more necessary than ever as a union, more than ever. Our relevance in the world depends on us getting it right and strengthening all pillars of the European Union. Otherwise, we'll just become absolutely irrelevant. Don't talk to me about the Russian threat. The Russian threat only exists because Europe is just too weak and not cohesive and doesn't provide a coordinated response, because we don't have a joint foreign policy, we don't have a joint security policy in spite of Mogherini's efforts. So we don't have what we need for a union of states or peoples, or whatever you like, that can respond to the challenges of this inevitable interdependence within globalization. And so we have to be aware of our responsibilities, shoulder the burden, discuss the challenges of the future, and stand together and not apart. But the union is about quality, not about quantity. Again, it's not about increasing bureaucracies so that all responsibilities are held at the center. It's about defining what we really need to have at the center, and also to grant democratic legitimacy. So I critically believe in Europe, and if I believed in Europe without a critical vision, I would be yielding to the temptations of those who feel they have to discuss, but what they need to discuss are the real problems and the problems of the future. And I am too old to yield to that temptation. Thank you.
Muchas gracias.
Well, thanks a lot. Thank you very much, President, for sharing such a clear vision of how to move forward to build the Europe we all want.
Which is called Perspectives and Challenges to Growth in a Changing Environment, and will focus very much on European banks and their profitability and competitiveness. I had a question here prepared for you, but unfortunately I can't make it since the app is not working. I'm really sorry for that again. It was going to be chaired by Santander's Head of Regulatory Affairs, José Manuel Campa, and he's joined by a wonderful group of panelists. Thank you.
Thank you, Alejandra. Good afternoon, everybody. It's hard to be a follower to what we just heard, but we're looking forward to participating in this last panel of the sessions, on the perspectives and challenges for growth in a changing environment. So far, we've heard about how to build trust in an area of disruption. We heard about the digital age. We heard about being responsible business. And we also had two incredible keynote speeches on the status of the world, mainly in Brazil and the European Union. In this panel, we'll mainly discuss, as Alejandra was saying, what are the prospects and challenges for growth, and in particularly with a focus on Europe and the banking sector, especially. Last month, the IMF had its annual meetings in Bali, and they came out with a review of the world economic outlook, and they did a downward revision. Well, they still look like good, positive growth, downward revision, but when you look at the components of the downward revision, basically was more on developed markets than on emerging markets, more on Europe than other developed markets, and that's part of the challenge that we're confronted with. And when you ask about what were the headwinds, the risks that they saw to that central scenario, the main one was probably the normalization of interest rates across mainly the Western Hemisphere, mainly in the United States first, but then in other countries, and the impact that that may have, particularly in the periphery. But then quickly came to Europe, and then quickly came to Brexit, came to the issues of incomplete banking union, Italy, things of that sort. And those challenges are pretty daunting. So I'm happy to have a great panel here, of four perfect participants to discuss these issues. We have a mixture of investors, regulators that were in policy making and banking, regulators that were in regulation and now are in advocacy. So that mix should be able to help us at least try to figure out what the key questions are. I'm not sure that we're able to get any answers. So let me introduce them quickly. Here from my left, farther on, from closer to me to farther to me, I would say, Yolanda Cortines is an equity portfolio manager from Wellington Management's Global Services. She's following banks and European banks for a really long time, and she's also very interested in the vice chair currently of Wellington's Investment Stewardship Committee. Yolanda, thank you very much for joining us. Then next we have Burkhard Bulz. He's the executive board member of the Bundesbank. He just joined the Bundesbank in September, if I'm not mistaken, after I think it's 9 years at the European Parliament, as member of the European Parliament. So he has a strong policy background as well. And prior to that, he was a banker. You may not want to recognize or remember it, but he used to work, if I'm not mistaken,
back to the roots,
for Commerzbank. Then he's also, I think, thank you very much for joining us, Bunker. I should say for joining us again, since you've been at least one or two other times in this conference in the past. Thank you very much. Next to him is José María Roldán. I'd like to welcome him. I think very well known by most of the audience. He's the chairman and CEO of the Spanish Banking Association. Prior to that, he was for decades a regulator and a supervisor of financial stability in the Bank of Spain, and very much engaged in international fora. And then finally, last but not least, we have Barrington Pitt Miller. He's a portfolio manager with Janus Henderson Investors, and he's been following, I could say also for decades, but maybe I'm wrong, for decades, European financials, particularly European banks. So thank you very much. And let me start with a general question for all of you. which is what I would say like the standard question that we get when we go outside Europe, which is basically, the world has been growing for like 6-7 years. The US has been growing faster than Europe in general. On top of that, we see European banks performing relatively worse than American banks. The return on equity of European banks is now probably in the range of 6 to 8%, while American banks are probably in the range of 12 to 16%. What is the reason? What's wrong? Why is that asymmetry? Is it the banks that are not helping growth? Is it growth that are not helping banks? What would you say is the reason? Yolanda, why don't you take the first step?
So I guess clearly Europe has a different banking model than the US. We hold mortgages on balance sheets here in Europe, which the US does not. So that has something to do with leverage and returns. It's a lower risk balance sheet on average, and so returns will be a little lower, and we should take that into account when we're thinking about valuations. But overall, I think about the low valuations of Europe, again, being constrained by growth, as you're saying. I think when you look longer term, how important is the growth? You can get the allocation of capital can go to dividends and payouts, and we can get our return that way, or it can get reinvested in the balance sheet, and the balance sheet can grow. And I think, unfortunately, Europe is still stuck in that first scenario of staying with a more static balance sheet and having to rely more on dividends. Hopefully that is where we are now, that dividends can start coming through, but the reality is in post the financial crisis until now, every additional dollar of capital that's been coming in has sort of been accrued on balance sheet to undo the leverage that happened pre the crisis.
Thank you. Barrington, you are the other investor in the panel, and you have an approach more from the US looking in. What would you say are the key components?
I completely agree with Yolanda on the structural point, but I think the structural point also harks to the structural issues of Europe, which is, yes, we hold the assets on the balance sheet, but that in turn means that the banking system itself is dramatically more integral to Europe than it is in the United States. 80% of banking assets to GDP in the US, roughly, 3 times that in Europe. It's 3 times more critical. And yet banking union has stopped halfway through, in the river. It's a half-built project. And when the next flood comes, the bridge could get washed away. Now, why is that relevant here? Because it tells you that's what doesn't allow for us to break the sovereign bank nexus. And that constantly, therefore, weighs on the cost of capital, it weighs on the banking sector, it weighs on confidence in the region. And I think, when you hear one of the largest pan-European banks, a large French one, announce at its third quarter what its cross-border intra-group credit line is to Italy, its own Italian business, that tells you there's a fundamental problem at the heart of the European system. And there's this utter lack of confidence that is not viewed as simply just a group credit line. It's viewed as an at-risk credit line.
You're pointing to something that I was sure it was going to come out as part of the answer, which is this idea of an incomplete banking union. But first, let me hear what you have to say about this point before we go into the specifics of the banking union.
I'm pretty sure that we will come back to the issue of banking union, but of course, trend growth rates differ across the countries, as does the strength of the underlying driving forces. That's for me clear. And in emerging market economies, growth tends to be considerably greater than in advanced economies due to a catching up process in the per capita income levels. So within the group of the industrial countries, demographic trends are contributing substantially to the growth differentials. So indeed, the European economies are suffering from particularly adverse demographics. According to data from the United Nations, the working age populations in the euro area has been shrinking since 2011. That means now for 7 years in a row. And this decline is projected to accelerate even further for the next 12 years, at least until 2030. And by contrast, the working age population in the United States is still growing, albeit slowly, but it's still growing. So having said that, there are, from my point of view, numerous factors affecting potential growth. The important thing to note here at our panel is, from my point of view, that strengthening potential growth is beyond the remit of central banks. This is up to economic policymakers who can take, of course, action by boosting immigration, promoting the participation of women and the elderly in the labor market, improving the competitiveness of the economies, reforming regulations in product and labor markets, and of course promoting the free trade, an issue which is absolutely important to discuss in these days.
I'm glad to hear that central banks cannot do everything everywhere. But you pointed to many of the issues that...
Well, you said I'm only for 2 months a central banker now, so maybe I have
You're
to
learning
learn
fast.
on that.
You're learning very fast. But you pointed to a number of issues that President González was also pointing, like immigration, demographics, which obviously are very, very structural. José María, what would you say about this issue of growth?
Okay, let me try to have another angle to probably to the same issues. What is missing in Europe, I would say, is scale. And in scale, I'm not talking about this 6% we represent in the world. I'm not proposing either to expand, geographically, or to have, 100 million migrants coming to Europe. What I'm referring to, let me be very, very clear, is scale of industries, and in particular, scale of banks. IT expenditure of a big European bank is around 2 billion euros. With 2 billion euros, if you are smart, you can do a lot of things. Do not take me wrong. What is the IT budget of JP Morgan? $11 billion. With $11 billion, you don't need to be smart. You just try 1 year, you fail. Try another year, you fail. Third year, you make it.
You fail.
It's done. You are the global leader. So when we discuss about Europe, what are the problems? I think a problem that is not usually recognized is that we need scale. And I'm talking about the banking sector, but I could be talking also about other sectors. What is the European Amazon? What is the European Google? Where is it? So I think that we have to consider why we have this lack of big players like the US has. And the elements there probably is, I would mention two. This wonderful word that is invented in Europe, that is muddle through. Muddle through means that we are extremely resilient in crisis. Do not take me wrong, muddle through is a great thing, because not being perfect, you manage to survive. And we have survived the last one, that was a big crisis, and we will survive the next one. But the problem of muddling through is that probably the type of solutions we end up having are suboptimal, because still member states' interests are very important. Second element, and we can go back to that later on, is gold plating of regulations. I think that that is another element where we have to consider a little bit whether we are making, the right decisions.
Very good. Let me pick up on this point that you said about the lack of scale, because it's a little bit of, I'm focusing on the banking sector. It's a little bit of paradoxical terms, Barrington. Before you mentioned that, Europe is very bankerized, that the presence of banks in the financial system is very high. But at the same time, when I look at average size of banks, the truth is that over the last decade in particular, but even before, the large banks, none of them are Europeans. In fact, the largest European bank is not in the banking union. It's HSBC, probably by size, right? So what do you think is the paradox for that? I mean, would you agree that the structure of the European functioning that does not allow for this scale to grow? Because at the same time, there's a big punishment for getting larger in the regulation.
I think I'd come back to banking union. I completely agree with your comment. I think the scale issue is critical. But you can't, it's very hard to create scale if you don't have confidence in the integrity of being a truly pan-European bank. And in discussions with management, there's the question of, well, do we need fully fledged banking union, or could we have a halfway house where if you're a European GSIB, you get sort of a systemically important bank, you get a special dispensation to be cross-border. That, if you are the management, is a very high-risk strategy, and as a shareholder also, because the possibility of the treatment of that institution in crisis ex post, as opposed to the promises ex ante, are very, very significant. And I think you're a very brave management to take on that possibility without a clear definition that this is an integrated, harmonized banking union. But I do absolutely agree. We've got big banks, but they're still fundamentally pretty nationally orientated. Obviously, our hosts are anything but. But that's more the exception rather than the rule.
Let me press you a little bit more on that. What would you consider to be the key missing components to have this fully integrated banking union?
Well, I think it's the confidence around liquidity, and therefore the deposit guarantee scheme, the backstops there. I think that, and indeed the President mentioned, a complete European project being economic and monetary, and that is utterly critical. As I say, you go back to that argument of if you are a true pan-European bank with a large Italian bank, the idea that the market is scrutinizing your funding lines into that institution tells you that there is a lack of confidence certainly from global investors, international investors not situated here, investing in euros. We've got the opportunity to think euro or dollar. And if you have that question mark in your mind, you're going to choose the dollar.
Yolanda, would you agree with liquidity as being the key component?
I was going to say something a bit provocative on this theme, which is just, you're talking about funding, and the raw material of a bank is low-cost deposits, large-scale and low-cost deposits. And we spent half the morning talking about digital, new competitors, fintech, and the likes. And right now, that competition is not competing for this raw material because interest rates aren't high enough for that to be relevant. But as we move towards higher rates, then the value of that raw material becomes absolutely critical to banks. And so it makes the whole idea of the deposit union that much more important. And then if you tie it back into the technology piece, implementing technological change in a complex sort of multi-country model like we have in Europe is definitely more expensive, it's more challenging, but we are going towards an industrialization of the banking system right now, where you are not just presenting a good digital front, but you are creating operational restructuring all the way through a bank to streamline it and make it more digital. And again, scale is absolutely imperative, I think, to be a winner in an industrialized banking world. So I do think all of these pieces coming together should hopefully be drivers for us to get closer to a banking union, but maybe we need a little bit of stress first.
Let me pick this up with you. You were for 9 years in the European Parliament. You were obviously an expert on policy making and decision making in Europe. How do you see the progress, or what do you think the progress is likely to be on these issues that are being highlighted here on completing banking union, particularly on the liquidity movement?
Well, of course, I've dealt with this issue, and you mentioned it for the last couple of years, and it's not a new issue. And when we look at the banking union, I think we have already achieved a lot, but there's one thing definitely missing, and this is, of course, common European deposit insurance scheme. For me, this is maybe also not a surprise to you. It is essential to achieve further progress on that, on the agreed roadmap. 2016, the European Union, European Council, also as a Parliament, agreed a roadmap, and this roadmap said that we need a sufficient level of further risk reduction in the European Union, in the Eurozone, before we can share more risks. I know that many people in Europe can't hear that hint anymore, but for us, risk reduction comprises really a further reduction of the risks of non-performing loans, for example, than the minimum standard for insolvency frameworks, and of course also a really effective resolution framework at the end. To be honest, from my point of view, quite a lot has been achieved in the last couple of years. But when you look at the circumstances at the moment, and I have to mention, of course, the issue of Italy here, then the question is if this is really the right time to proceed, to move forward here. As of now, if you ask me, we are still far from a consensus on how to design such a deposit insurance scheme. Because a fully fledged EDIS, as it is called in Europe, particularly without a preceding extensive reduction of risk, could result in the end, of course, in moral hazard problems. Banks may not engage in further risk reduction given that responsibility and cost bearing are not balanced. So therefore, I wish really to highlight once again that we need progress in risk reduction, definitely, before we can engage in further risk sharing via EDIS. The circumstances in Europe, especially with some specific countries, those circumstances have to be solved.
Right. As you know, many people are suggesting that there's so much risk reduction being asked that at the end there might not be any risk to share anymore, so that the benefits of the union may disappear.
I've heard that argument also quite a lot of times.
So, Jose Maria, you mentioned this also the idea of going a little bit beyond just the EDIs, of gold plating and other types of regulation. What do you think are the progress that we need to make there?
I think that I would mention several areas where I see Europe, gold plating and to some extent leading by example, which has a very good element in it. I would mention, sustainable finance. I would mention GDPR. I would mention resolution as one of the elements, and I would mention PSD2, this payments directive that opens, competition from fintechs towards the banks. Some of them are leading by example, sustainable finance, GDPR. But at the same time, we should make the question, okay, fine, given that we are in the advantage of this type of regulations, shouldn't we consider what is the impact on the level playing field of the European economy, European banks? Let me put another example. IFRS 9, expected loss provisioning. We are going to apply this 2 years ahead of the US applying this. We all hope that the US will apply it by the end of 2020. No, it's the end of 2019, beginning of 2020. Okay, fine, but we have no guarantee. The reality is that IFRS 9 is applied in Europe, and it's causing some stress for some banks in the stress test. And the US, we have the promise that this will be applied. I think that, for instance, in some of the regulations that we do, and I'm thinking on resolution and other elements, we should include a backstop in regulation. Unless this regulation is applied globally, we will not go ahead. Because it's fine to lead by example, as long as the others follow your example. Because leading by example, and looking behind and seeing that you are alone, that is not very smart.
That's not leading.
That's not leading.
That's getting lost.
That is losing your way.
Exactly. Yes, Porter.
Yeah, maybe on that issue, we should not only focus on the banking union itself. Of course, it's the most crucial project for the Eurozone and for Europe in this respect. But also, I think we should speak in this circumstances on the capital markets union. If you ask me, there was quite a big determination from the European Commission and also European stakeholders over the time, but with the leave of Jonathan Hill, the Financial Services Commissioner, I observed then that there was, out of a sudden, a certain lack of determination and also commitment. So when you ask this question, of course, completing the banking union is one big issue. It's the most dominant issue, for sure. But also, we need to improve things on the CMU side.
I fully agree. and I'm glad you brought it up. But let me ask the panel, is there consensus on your view that this is basically dead in the short term, or the momentum is lost in the process of the capital market union in Europe? Because the Commission has a very active agenda.
Yeah, but at the same time, I mean, the project has totally stalled. They have this beautiful agenda. They have these low-hanging fruits. I don't know where the low-hanging fruits are. They are not on the table, by the way. So probably they were not so low-hanging.
They were so low-hanging fruits, but they were earned over a couple of months at the beginning, and now
everything is stopped. And frankly speaking, in the context of Brexit, not to develop capital markets union in the European Union is suicidal. I cannot understand why this is not just up in the priority. The first priority we should have, because probably, I mean, on banking union, deposit insurance scheme, well, the moment is not ripe to make progress, and we can understand that for obvious reasons. But capital markets union, I mean, come on, let's do it. Why are we waiting? What are we waiting for? In the context of Brexit, not to deepen European capital markets is just suicidal, frankly speaking.
Yeah. We have a couple of questions from the audience that are very much linked to what we're having, so let me just phrase it right now. One is about the issue of deregulation in the U.S., or asymmetry in regulation between the U.S. and Europe. You know, is there really divergence, or is it likely that there's going to be divergence or not? I don't know if you have views on this, or you think that, that we're talking a lot about relatively minor things in a world which is essentially converging.
Well, Yolanda referenced the structural difference between the two regions. I think that's critical. And gold plating. I think the US will sit and argue they've gold plated, whether it's on operational risk-weighted assets or supplementary leverage ratios. The Europeans will sit and argue we've gold plated in other aspects. But I mean, I think you've got to look at structural profitability alongside regulatory issues. And I just highlight one, and that is the operational risk charge to Bank of America Merrill Lynch stands at $500 billion. That is larger than the combined operational risk charge of 5 of the larger investment banks in Europe, including Deutsche and 2 Swiss. And yet, out of the investment banks in Europe, 3 of them don't generate more than a 30 basis point return on assets. And their leverage is 2 times that of their US peers. So where is the right risk metric there? Is it that the risk weight should be higher? Is it that the leverage ratio should be different? Or should we focus on the profitability? And I would ask that we actually focus a little bit on the profitability. And I would ask the regulators in Europe to do that a little bit. Because going back to the capital markets union, yes, the structure is very different. But maybe the balance sheets in Europe, ultimately, if we had the capital markets union, could release some of the low-yielding assets and allow investors to focus on a profile of balance sheet that is not, on average, 40 basis points return on assets, which is 1/3 of the US, with twice the leverage, and 10 times the non-performing loan portfolio. Yes, there are differences in structures, but that, as an international investor, is not deeply compelling when the PE multiple is 9 times in the US large cap universals today and 9 times in Europe. Yeah, there are differences around that, around all those numbers, by the way.
Market to book
but that's, you know, you want superior growth, structural profitability, a good balance sheet, and no existential risks. Kind of, we could put a cross in all of the boxes.
I was going to say, I mean, the European business, the European banking model is a universal banking model, distinct from the US. You actually have a lot of sources of income that are not that balance sheet intensive. There's a lot of interesting things you can do on the asset management, the insurance, the pension side, and the investment banking side, along with your retail and commercial banking. So getting that piece of the equation right could do a lot to help returns. And over time, there's no reason that, with the right rate environment, of course, as the starting point, that you can't have very attractive risk-adjusted returns in Europe.
One of the issues that's very commonly mentioned, and is here also one of the questions, is the issue of, it's very much linked to the aspect we were discussing before about scale, and having the right scale, is the issue of potential consolidation or excess capacity within the banking union in Europe. Now, I'd like to hear your views about this, to what extent you think this is really prevalent, whether it's something that is damaging the profitability of the overall industry. Well, it's a necessary process that we have to engage through. I don't know, Jose Maria?
I mean, very clearly, this is not the official position of the Spanish Banking Association, because I'm not sure that the banks would agree with me. No. But, I mean, banks are an increasing returns to scale industry. Size does help to increase profitability. That's a given. In particular, the story of the Spanish banks, the most successful Spanish banks, come from that story of growing, of becoming bigger. In the context of things like digital transformation or sustainable finance, when this hits us, that is going to hit us sooner or later, when you hear some of the things that were mentioned this morning in the video, it's even more the case. It's even more the case that the scale is going to be fundamental. You compare that to the US, and what we have compared to the US, we have a good number of big banks, but not big as the US ones. We have a lot of let's call them middle-class banks that are a little bit, nowhere, subject to a regulation that is almost mission impossible to comply with, like a 26% MREL, resolution capital of 26% for some of these institutions is just, are you kidding me? How the hell am I going to find this in the market? And then you have the small institutions, which the Germans are the clear example, where, like in the US, they coexist, they are very small, they serve communities, it's probably a different animal. I think that we have to think that, if we don't manage to have banks the scale of the US banks 10, 15 years down the road, we will be, like it was mentioned by President González, we will be a museum, including a banking museum. And I prefer not to be in a museum as well.
We already have a museum in the bank.
Yeah, by the way, a very good one.
Yes, Burkhard, please.
Yeah, maybe from my point of view, banks should really evaluate their potential for consolidation as one among many possible options for increasing efficiency or reducing costs. And also in Europe, it's always an issue, what about cross-border consolidation? Whenever you are talking about this issue, of course, from a European perspective, then the question is there any possibility at the moment really to have bigger cross-border mergers? I would say here, I want, at the end, want to have stable and also very important profitable banks. Stability, profitability, and sustainability are the main criteria from the supervision perspective. So we are neither aiming at a certain number of institutions nor at a certain size. But of course you are right that certain growth for banks is important. And one point also to mention from a central banking perspective, we have certainly also not forgotten about the too big to fail problem. I have to mention that also. So if you ask me, there's no matter whether we are talking about small or big banks, whether a particular merger makes economic sense, it must be assessed case by case by the market participants.
I mean, all I would add to the discussion is just the rules for bank M&A have changed in a digital world. Do you need to put two balance sheets together to get more distribution of a lot of branches and to buy customers? Or can you acquire those customers in far less expensive ways on an organic basis? And I think that's what banks are grappling with. And because there's so much change going on in the environment right now, and because there is uncertainty in Europe, and because we are probably late cycle right now, buying someone else's balance sheet when you don't know how they've underwritten their loans is a very risky proposition, and the risk reward just isn't there. So I do see the problem with the small banks. They have a huge amount of challenges ahead, but to me, those will be sort of take-under situations, not take-over situations. Those banks will ultimately just have to find a taker at very low value.
Yolanda, let me ask you a question now, because I think one of the big key themes of this conference is responsible banking. And you are, as I said before in my introduction, you are, if I'm not mistaken, the vice chair of the Investment Stewardship Committee in your organization. So, we just had a panel earlier today about responsible banking. Does it pay?
To be responsible.
Yeah, do investors value it? How do you value it? How do you assess it?
So when I have conversation, when Ana Martín asked me why is Santander's share under pressure, right? And there's lots of reasons that we've talked today about why it's challenging to be a bank and lots of short-termism. I think the challenge for any bank with strong governance is the ability to think long-term, to be adaptable, and to focus on that sort of end, shall we say, where the business model is going. So when you think about the average holding period for banks right now, or for companies generally right now, it's under 2 years. It used to be 6 years, right? The short-termism in the market is very stark. And I think it's our responsibility as investors to engage with the companies that we own and to think longer term. And then those things start to matter more. When you take a 10-year horizon, the facts that matter in an investment case, it's not going to be Italy. It's not going to be even the short term. Does a deposit union happen now or happen in a few years with a bit more risk? It's going to be who was there with their client, building brand, building trust, having very strong governance and risk culture so that you're reducing the volatility of earnings and mitigating risk over the long term, and being ahead of where, I think on the sustainable side, the market is very much going towards regulation, whether it be on the energy side or whether it be on treating your customers fairly and conduct. We've seen a lot of that already. And being ahead of that may feel costly today, but the market and all of these trends are going to intersect. And I think being ahead of it may feel like you're standing alone, but I think it's absolutely the direction to go, and it's something that we as investors should be spending a lot more time thinking about and extending our time horizon.
This brings me to another question that I got here from the audience, which basically says, why is the cost of equity of banks so high? Is it due to regulation? Is it due to uncertainty about their future?
Leverage.
There are two questions. I don't know if it's too high. It says the cost of capital is high. Would you agree with that statement, first of all?
I would just say where European banks trade relative to the European market is a little wider than its historic average, but not dramatically wide versus its historic average. So it's not specifically a European banks issue. It is a Europe issue. And then European banks are levered exposure to the European economy, and therefore there is that stress that you see.
And I think, as Yolanda said earlier, the perception, the late cycle perception, U.S. banks trading in line, large caps in line with Europeans on the average. That's unusual. There is the opposite. The question mark, I think, for Europe is whether or not U.S. are trading on a low multiple on peak earnings and Europe's trading on trough earnings or close to, on depressed earnings, and should, see a higher multiple one day if we get a rate cycle. I think the challenge is, are we concerned about the late cycle such that Europe never gets the cycle? And then when I look around the world, Indian banks have come off with the latest sort of taper tantrum, if you like, and liquidity challenges, trading at standard deviation below the last 5 years. Chinese large cap banks, mid-teen ROEs, and they're trading at 5 times earnings. So there's an awful lot of depressed bank share prices out there. It's not a European syndrome only.
Mm-hmm. When you talk to regulators and supervisors on this issue, they tend to be puzzled. And they say, we put forward all this regulation that supposedly makes these banks safer. However, we do not see, or apparently we do not see, a decrease in the cost of equity or the cost of capital of these banks. Do you think this paradox is really a paradox? Are banks safer? Maybe they may be safer and less profitable, but they're still risky or not? Jose Maria, you can make something.
I think that point is very interesting. Cost of capital, 10% before the crisis. We have the crisis, the losses, everything, consolidation. We have multiplied the bank's capital by 3. Cost of capital, 10%. It's kind of like a cosmological constant. Whatever happens, cost of capital for banks is going to be 10%, which is for me very bizarre. If we are making banks safer, and it's obvious that they are safer in terms of lower leverage, higher capital, liquidity, any aspect, governance, any aspect you look at, banks are far more stable than they were before the crisis. core equity figures are there. I mean, cost of capital should go down. The reality is that it is not going down, even in an environment where we still live in negative interest rates in the Eurozone. Huh? So for me, it's kind of a puzzle. You know, to some extent, I understand that because of the impact of the crisis, because of some late problems, you know, arising from the crisis, investors may still look at the banking sector and say, oh, let's be careful. I mean, this continues to be risky. Let's be on the safe side. But I think that over time, as these, you know, type of elements peter out, I think that we should see a reduction in the cost of capital figures, because we have a banking sector that is far safer than it was before the crisis. Maybe we need a recession, not a 10% recession, please, but a recession, a business cycle recession, so that people realize, well, I mean, yes, it's true, the banks are better than they were before the crisis, and yes, we can relax a little bit. But for me, it's a puzzle.
Of course, Burkhard, some of your messages before seem to suggest that additional risk reduction is still needed within banks, so the banks may not be as safe as we're claiming.
Maybe this is, of course, linked to those issues. So from my point of view, I think we really have to go down this path, and then I'm pretty sure we will see also other figures in the cost of capital.
Can I comment on this? Yeah. I mean, this risk reduction, risk sharing debate is starting to look like another adolescent discussion. No, I'm ready to move, but you move first. No. I'm ready to move. You have to move first.
I imagine. Quite critical. As
but yeah? From the point of view of the Americans, I'm sure that they don't understand this risk reduction, risk sharing. We have to do both. And you know what? My personal opinion is that given the situation that we have with a given country that is not a limited size inside Europe, I'm ready to give up sequencing. Let's go for risk reduction, and then we can have risk sharing. I'm ready to give up to Germany so that they feel relief. Because why? Because anyway, we need risk reduction. For your own business purposes, be loaded with non-performing loans is not nice when you are dealing with digital transformation, sustainable finance, etc. So, I mean, I give up. We have sequencing. First risk reduction, and then we go for risk sharing. But do not forget risk sharing later on.
Well, the nice way forward. I want to make sure that I give the opportunity to anybody that wants to ask a question directly from the audience. I've been getting some questions on the iPad, but if there's any question.
I fully agree, by the way, with your view.
No? Okay, I have plenty of questions, so I have no problems. Okay. But let me go back to the beginning. You know, one of the issues that we were discussing was about potential growth and the situation of banks in potential growth. And one of the key risks that I mentioned that was present at the IMF discussion that we have not mentioned at all so far in the debate is Brexit, and the role that Brexit will play for financial stability, for banks, and for financial industry over the medium and long term on growth. So I don't know how you're viewing Brexit in this context.
It's a very challenging investment environment, right? There's a lot of uncertainty near term, and that gets discounted into share prices. And then the medium term, again, that uncertainty will weigh on the growth scenario. And I think it's not, I mean, I think we shouldn't be complacent. I think it's going to be on both sides of the equation. It's going to be in the UK, and it's going to be on Europe as well. And I think that goes back to we should be thinking about investing in a relatively low growth environment. I don't think there's an immediate exit strategy from those concerns.
And how concerned should we be about financial disruption in the short term, in different scenarios?
I'm much less worried about that.
Much less worried about that.
Yeah. Okay. Well, the biggest problem is that really nobody until now knows what the outcome of the negotiations will be. Nobody knows what at the end will be within the contract, and how the European Union and the United Kingdom will, of course, then deal with their future relationship. So I think the uncertainty is the biggest problem we still have, because at the moment you have really to prepare for the worst. You have no other option from a banking perspective. But will this really be the case then at the end? I would make there a question mark, but of course my advice is to prepare for the worst and still hope for the best.
I think that my advice to all the parties involved is try to kick the can down the road. I know it doesn't sound great and heroical, but God, it works in the situations where there's no solution. So extend negotiation, extend transition period, as farther in the future as we can. I mean, 5 years, 10 years negotiating the whole thing. I know it's going to be painful. It's very painful to be discussing these things, but at the same time, you know, I rather avoid the cliff. Brexit is not something I'm ready to leave. I would prefer not to go through that. I don't think it would be a good experience, for sure, for the UK, but not for none of us. So let's try to kick the can down the road.
Well, I think it was interesting that the no-deal Brexit, the no-deal scenario was really raised by Europe in the summer, back in the early part of the summer. And I think that was a sort of a warning shot to say, look, start preparing for the worst, as Burkhard said. And as suggested, you know, absolutely no desire to go anywhere near that no deal. In other words, UK start thinking about what that would mean. Once you've thought about it, you realise it's very, very ugly, in which case we need a no-deal transition deal. Yeah. So, you know, you know, that's the reality. And I think we heard some sensible comments from ESMA and indeed other bodies who sort of highlighted, look, you know, there's been horror stories of, you know, if you're on a British Airways plane at Charles de Gaulle and the day it happens, you won't be able to take off, and then all derivatives, you know, would collapse, the derivatives market would collapse overnight. They've clearly stepped in and said, look, that's just unsustainable. We can't go there. The emergency transition, no deal transition. That's the only way forward. So to Yolanda's point, I think, you know, I'm not that panicked that there will be a major market event. Rather, yes, we just don't know the economic uncertainties. That's the challenge.
Right. Very good. It's good to hear that you're pretty comfortable. You know, I think it's one of the general dimensions that we tend to have. We tend to sort of like cry out, "This is going to be a disaster." Disaster. It happens, and then we sort of like muddle through. We seem to live through it.
I love muddle through.
I hope you're right. You just kick the can, but I hope you're right, and I hope we meet again next year in a very stable growth environment like we have today. And I know we're out of time. Alejandra was just signaling to me. So please, I would like to thank all the speakers and to give them a big hand of applause. Thank you. Thank you. Thank you. Thank you.
That was great. Thank you very much for a great discussion. For our closing session, we're going to welcome back James Harding, who will moderate our discussion with our CEO, José Antonio Alvarez, and David Wright, Chairman of Eurofi. And James will then provide us some summary of his conclusions from the panels and the discussions today. Thank you for the three of us.
Take a seat, David.
Oh.
Who's that?
Ladies and gentlemen, I seem to have a job today which is introducing people who need no introduction. David Wright, the chair of Eurofi. If you actually read the brilliant biography of David that's been made available, you have that creeping sense that along with all those titles, it's David's world, we just live in it. If you look at the work that he's done, he's been one of the most significant public servants in Europe over the course of a generation, and it's brilliant to have you here today, David. And José Antonio Alvarez, of course you all know, is the chief executive of Santander, and the person as both CEO and then before that CFO steered this bank through some quite busy times. So it's great to have you both. What I thought would be useful to do, and if I might, I was going to start with you, David. We've spent the day thinking about a very specific set of issues, this relationship between responsibility and technology. But given the perspective you've got and the way in which, in European policy-making terms, there's an agenda that spreads well beyond just this responsibility agenda and well beyond the technology disruption issues, I just wondered whether you could start by giving us a sense of, if you like, over the horizon, what the next 5-10-year policy issues look like.
Well, thank you very much, James, and thank you very much for inviting me here. I want to thank José Antonio, which is well overdue, by the way, because when I was in the European Commission at the coalface, right in the worst moments of the crisis, he was one of the very few people I talked to for advice about how the markets were, the risks. And we exchanged information, and I have to say what he told me was just superb and very influential, and went right to the top of the European institutions. So I want to thank you for that. Well, we've discussed some of the issues. The way I look at it is we simply have inadequate growth in Europe. We have a banking union that's incomplete. We've just heard that. Capital markets union, which in my view has failed. We haven't created pools of capital. We haven't diversified our financing system. And by the way, I think a diversified financing system is good for Banco Santander, not bad for Banco. So I don't understand bank centricity. A bank like Banco Santander does all forms of financing and will continue to do so in the future. In short term, of course, we've got to sort this Brexit mess out. I think, remain optimistic we will. But looking at the broader, longer-term agenda outside these responsible banking issues, well, I think security, and we haven't talked a great deal about security, but cybersecurity is right up there. I am sure every day this bank is attacked. I heard some astronomical numbers from Citibank and others, and my own work on board, so I know that this is incessant and will continue to be so. So I think protecting institutions, cooperating internationally is crucial. I think this another area we haven't really talked a lot about, but I sense this money laundering, terrorist financing, tax evasion agenda is going to become much bigger. Not just because of recent events, but for broader issues. The cashless society. I don't know what Banco Santander's view is of the cashless society, but any economies which have a significant percentage of its GDP on the black, from a public perspective, this makes a great deal of sense. And I wonder whether in Europe we shouldn't be striving to move in that direction. Aging demographics, pensions, I think pan-European pensions become one of the great potential pools of capital in the future. We are the leaders in Europe on investment funds. We have the global standard, OPCVM, UCITS. No reason why we can't do this with the political will on pensions. And if it was pari passu, it would be 10 trillion euros of pool of capital after a few years. I very much agree with what Anna Botín said this morning about fair competition. I think what she said was absolutely right. And from a regulatory perspective, if it's an elephant, you regulate it as an elephant, not as a giraffe. And if you don't do that, you create distortions in markets, unfair competition. So I'm all in favor of competition. I'm sure we all are here, but it's got to be fair. And I think what she said, including, I absolutely agree with her, about fair payment of taxation. Final point, data. We're not very good at this, actually, from a regulatory perspective. I suspect that most consumer organizations, let's just take one, Zara Home or Zara in the high street in Calle Serrano, or Tesco in the UK, know far more about their customers than probably most financial institutions do. And as far as regulators are concerned, we don't have real-time data. We really don't know where the money's moving domestically, globally. So I think there is a huge agenda to improve data in the global financial system. And I think that it's actually irresponsible not to do so, because, after all, this crisis cost us 25% estimate of GDP on a global basis. I'm not going to talk global for the time being, but those are some first thoughts.
Well, David, thank you very much. Jose Antonio, I'm going to come to you in one moment. Can I just understand two things just on the points that you made? One, on a cashless society. Are you saying that you think that some European countries or Europe as a whole should aim for a totally cashless society, or largely?
Well, logically, entirely. I think you'd have to phase that in over time. You have to bear in mind some people are less apt or generations change. But I think we should definitely aim towards that, yes. A totally cashless society. I mean, we are ahead, actually, in Europe compared to the United States here. Yeah. Well ahead already. I mean, the US, I was talking to somebody yesterday, still using checks. Yes. I can't remember when did we last use a check, anybody in this room? I mean, we have to build competitive advantage. And I think sort of sustainable development, cashless society, using digitalization to drive financial markets in a responsible, socially responsible way will be a competitive advantage for Europe, and we should go for it.
Okay. And then, David, just one other thing. You said very boldly that on capital markets and diversification of the financial system that Europe has failed. And I'm presuming you're thinking in that is a competitive disadvantage for Europe as a whole.
Yes. No, I mean,
just explain why and what you do about that.
Well, I think I think the new European political cycle, which begins in November next year, has to reboot the whole project. The project has failed because it never had buy-in at the top political level. It didn't have any timetabling. It was open-ended. And there was a lack of purpose. I think José María Roldán said that as well, a lack of buy-in at the political level. And so broadening out the financial system, making sure that we can finance all forms of society, including innovation, SMEs, so vital for the future of Europe, and also this inclusive agenda that others have referred to today, I think is absolutely essential. And once London goes, we don't really have a very diversified financial system in Europe, which raises another question of what type of relationship should Europe want with London.
Yeah. Jose Antonio, I'd like to, in this session, get a look ahead from you, particularly around the discussions we've had, the relationship between technology and banking. But before we do that, can we just pick up on the points David's making, because he's talking about an agenda for the financial system in Europe which goes well beyond just these issues, this relationship, if you like, with innovation and disruption. He's talking about some really profound structural changes on capital markets, on the relationship with London, on the relationship in pensions and in cash. When you look at those issues with a sort of 5-10-year horizon, what do you think are the changes that Europe needs?
Okay, Capital Market Unions, I agree with David. Thank you, David, for taking some of my ideas in the middle of the crisis just to push through the European Commission. Capital Market Union, the agenda was ambitious, was very open agenda. Till now, we haven't seen that much progress. Yeah? So we have here what I see like a lack of push from the political side. On the other side, probably the agenda was too ambitious in one sense. We were comparing ourselves with the States. And the comparisons always tell the number the people use, always say, oh, in the States, 70% of the funding to the companies, or 75 or whatever, 65, is provided by the market, and the banks provided like 25%. While in Europe, it's exactly the opposite. This probably is true, is what it is. Probably we can have a big deal in Europe to advance in this regard, but not up to the point the States are. Why is that? Because access to capital markets requires significant size of the companies that try to access to the capital markets. And when you look at the companies in Europe, the majority of the companies, the overwhelming majority of the companies, were created and incorporated and developed thinking in a local market. And the local market was maybe Germany, maybe Spain, maybe Portugal, and the size of those companies is relatively small. When you try to access to capital markets, my experience in banking has been to access to the capital markets all the time, still a complex and difficult process. The first thing you go to access to the capital market, someone else requires you, where is your rating?
Yes.
Oh, painful work with the rating agencies, all the financials, everything, plenty of stuff get done, and finally you get a rating. If you are lucky, probably you get a rating that is, if you are a small company, this is not realistic. So once you get the rating, suppose you are a medium-sized company, you go there and you need to build, to register a prospectus.
So can I understand, José Antonio, it's a very big point that you'll never really move to a capital market system that's similar to the US or China, not because of economic history, but more because of economic geography, that these businesses are rooted in national markets.
The discussion that we had before, about the potential, the banking union, the restriction to the banking union, the same happened with companies in one way or another. So probably you need some kind of consolidation, some kind of European kind of companies that have enough size to tap the capital markets. Okay. Otherwise, it's going to be impossible. Yeah.
And what about David's point about trying to take the competitive advantage, if you see it as that, in cashlessness, in digital ownership of money? Do you think that is a competitive advantage in Europe?
Sure. It costs a fortune. To manage cash, it costs a fortune. Not only in Europe. We are pushing that, for example, in Mexico or in Brazil, where the cash problem is even bigger and bigger is much bigger than Europe. Cashless society, you see how much it costs to the society to move cash here and there and to pay cash is a fortune. And the main interest should be the governments, because the taxation is much easier when you have cashless society. Yeah. So and this is advanced pretty well in the Nordic countries. It's not unusual to find shops and hotels and restaurants that they put a sign that say cashless, cash-free. They use cash-free.
That's right. Yeah, it's happened.
So cash-free. And this is an advantage, a clear advantage.
All right, and I've been sitting next to George Bridges for part of the day, and we went for a long time, I think, until José Manuel raised Brexit. But now David has made the point, and you can't avoid it, that a big question remains about what Europe's relationship with London should be.
You mean in capital markets?
Actually, I mean in the whole financial system.
The whole financial system. Well, we have a starting point. The starting point is the markets, the hub for the markets is London. The clearinghouse are based in London, and all the intermediation is done through the London facilities, one way or another through the London facilities, and we are working on this way. Having said that, it's understandable that from the political side, and some countries have stated clearly this, that they want to have the last say in case the financial stability is under threat. And this is understandable from the political side. If I were an official, a civil servant from the ECB, I want to have control of this. It's my duty, and I want to have control of this. So we can go into a pragmatic way and try to develop these kind of facilities and things in continental Europe, or reach some kind of agreement, whatever it means. I don't know what it means exactly. Maybe a transitional period, relatively long period, in order to allow to build the facilities and to build the market, because the problem is the market. The problem is how efficient is the market. Those market needs huge volumes to be efficient. And in order to build those volumes, the question is, those volumes were built in London along the last 30 years, and the volumes are there, but to build those volumes takes time. If there is a cliff there, what is going to happen? Capital markets in Europe become significantly less efficient than they were with the facilities in London. Why is that? Because the bid-offer spread will go up significantly. So we have this problem. This problem is there. I'm optimistic on this. I think that some kind of transitional agreement is going to be reached. In some parts of the business, particularly in the funding business, the ECB need to do as soon as they can. In other parts, like the derivatives and all these things, the clearinghouse you can take for a while, and probably you need more time to build this. But definitively, financial stability, if financial stability is at stake, you should reach an agreement and develop your own facilities.
And can I ask a very simple question? You know, if you go to Paris these days and you ask Parisians, I guess if you ask Parisians, they'll always say things are good for Paris. But if you ask Parisians, they will say Brexit will be good for the financial services sector in France, in Paris. Will Brexit be good for the financial services sector in Madrid?
Well, I don't think that we're going to have another hub like the London one.
No.
I don't think that the financial industry is going to go, assuming the Brexit go in the direction that apparently is going today, I assume that we're going to have kind of a one hub or several hubs across Europe, more than one single hub. If we look at the States, now when I was CFO, I was doing a lot of traveling around the States to face investors. London was extremely efficient because you go there, you stay there for 3 days, and you see, I don't know, 30% of your shareholder base, or 40%. That's it. 3 days, the same city, deal done. You go to the States, you fly New York naturally, but you need to go to Boston to spend another day in Boston, another day maybe in San Francisco, LA, yep. Another day maybe in Denver. Maybe you need to go to Texas to see someone else. And the market was more fragmented, or at least the investors, the asset managers were much more. And I do think Europe probably is heading in this direction. Have some business coming out of London and going some of them to Paris, some of them to Frankfurt, Amsterdam, maybe Milan, maybe Madrid, some of these. Even some investment banks, probably they are deconcentrating in London and splitting the people among the countries in which they have business. Probably is what I do see. What remains to be seen is what happens with the clearing houses. That is probably the main focus that can attract the rest of the market to a single place. Yeah?
Interesting. And David, let me ask you to answer your own question. What do you think the relationship, you know, assuming Brexit goes ahead, with London should be?
Well, I think, in a way, I think Europe has two choices here. I mean, it can be an inward-looking Europe, an inward-looking capital market in which it tries to develop capital markets union, bank, etc., with rather restrictive access opportunities for third countries. Or it can be an open approach, and the open approach, in my view, will be better from the long-term economic perspective of Europe. Now, what José Antonio said about the financial stability side, I fully understand that. And again, you have a choice here, whether you regulate so the ECB or whoever it is has the instruments to deal with these particular issues, or you build trust and cooperation with, let's say, the UK, Bank of England, regulators and so forth. I much prefer that rather than the former. The way it's looking now is that the outcome will be some sort of equivalence-based approach. Whether equivalence gets moved into other directives, that's not clear yet. The UK is pressing for more predictability on equivalence. It wants more process. It wants some form of ex-ante consultation, or at least some means of contesting. It wants a longer time frame in which if the European institutions decide the UK rules are not equivalent, then there has to be a reasonable wind-down time, not 30 days. All of that, I think, is up for grabs in the transitional phase, assuming we get that. And the problem with the uncertainty about not knowing whether we're going to get to a transitional phase is that there are a number of contractual continuity issues, particularly around clear derivatives. Some people argue unclear derivatives as well, insurance contracts, data, that need to be resolved right now, given the uncertainties. And I don't think the European institutions are doing themselves any favor by delaying that.
So you're not in favor of José María Roldán's let's kick the can down the road?
No,
as fun as he made that sound, I should say.
I always agree with Jose, but I think for these types of stability issues, you shouldn't play with fire. Let's deal with them, and you can have they can be very short timing on them, whatever. But let's not take any risk. And one of the problems, and I've talked a lot about this with various people, is that it may be that Banco Santander is perfectly well aware and wants to deal with all these unmatched derivative contracts, but its clients are just nowhere to be seen. The paperwork is missing or whatever, and there just isn't time right now to deal with all these problems. So you need some sort of temporary permissions regime or some form of continuity of contractual arrangements until and these things can be wound down in the transitional phase. But to me, the big issue is, what is going to be the most beneficial for Europe? That's how I like to look at it. What will get Europe to a higher growth rate and so forth. And I don't think an inward-looking rent-seeking approach from the UK or indeed from any other third country is the right way to go about it.
Very good, David. Thank you very much. All right, Jose Antonio, I want to go back, if you like, to the question that we started with right at the beginning of the day. And I guess it's a question you've actually lived every day for a number of years now, which is, how do you run a responsible bank in an age of disruption? And it's felt to me as though through the course of the day we've had this question, which is, why should we think a bank will be better than an algorithm? For us as a customer, for the economy, for society. And so I wondered whether you would sort of stand back and give your thoughts about that.
Okay, this idea of responsible banking, first idea goes beyond what people think about compliance and conduct. Traditionally, responsible banking means related, I comply with everything I should comply, the conduct is right. No, it's much more powerful than that in our vision. In Santander vision, responsible banking means then that we fulfill expectations of all our stakeholders. That's the idea behind responsible banking. What this means? Our stakeholders, the first stakeholder we have and we can match and we should manage in a proper way is employees. Mm-hmm. Our employees should come to the bank having the feeling that they come every day for a purpose. Mm-hmm. That's extremely important. If they feel that they have a purpose, they have a career here, they are treated fairly, they will serve our second stakeholder, that is customers, properly. With the idea, with the customer, the idea is very simple. Solving the customer problem. It's as simple as that, as difficult as that. Yeah? Everything we do has an idea, solving the customer problem. If we do well or not, it's something that we can discuss. But this is the idea at the center of the relationship with the customers, and the idea that we want every employee in the Santander Bank, we want to have in his or her mind. Yeah? So those are the first two stakeholders. If we do these two things well, the third one is relatively easy. Our shareholders, we will have happy customers, more loyal customers, and our shareholders, we will make money out of this, the investment, and become profitable. The guys who trust us with giving us 70 billion euros capital, we will be able to give them the return they deserve for putting at risk their capital, trusting in the Santander management capabilities to do that. And finally, you have the society. And the society, we have different angles. Particularly with our diversification, we have an angle that this morning came to the table, that is the financial inclusion. That is not only a problem, as we saw this morning with John Hope, that he was speaking mainly from the States. It's not only a problem in emerging markets, as we tend to think, but it's more, the problem is more important in emerging markets than it is in mature markets, but also in the mature markets is this. So this is an angle. And we have the other angle in the society that, we should act in a responsible way in the things we do in relation with the problems the society faces. And we have policies for climate change, environment, all these things that we, as a At the end, we are intermediaries between the savers and investors, and those investors, we need to take care that, well, the way and the activities in which they invest the money are in that way fill the purpose that we want, that is prosperity for the companies and for the business. This is the idea of responsible banking, fulfilling the expectations of all these shareholders. And if we got that, employees, and we are not only saying this. You see our targets in the Investor Day, where we had targets for all these stakeholders. We have targets for employees, to be a great place to work in the majority of the markets in which we work. Naturally, we establish targets for customers, loyalties, number of digital customers, how we are progressing there. Naturally, shareholders, as you may imagine, in Investor Day, we establish targets for shareholders and also for the society. And the society, in the society, not less that we pay significant taxes, as our chairman said today, the 36% tax rate that everyone else in the company remembers. So that's what I mean responsible banking. If we are able to do so, we're going to be a successful bank. There is no trade-off between responsible banking and profitability in the way we look at it. So you start with employees, customers, this translates into profitable banking, and there is no a trade-off that you are more responsible, you get less profits. I heard this morning some people saying, oh, you should pay some prices in the short run in order to be sustainable in the long run. I don't think this is a realistic trade-off. You should accommodate without disruptions to the trends in the world, without significant disruption, because, well, one of the things we should give to all our customers and to all our stakeholders is our business is based on confidence. And disruptions in this kind of business, where you talk about money, means risk. And risk produce some erosion in the confidence. So we should be extremely careful to accommodate ourselves.
But can I ask you, because it seems to me as though this is a perfect place to end. Right. When Anna Botin was sitting here this morning, one of the issues she talked about was timing. And if you listen to the session that George Bridges ran, one of the things that was very striking was hearing people say, look, there is a price for virtue, there's a cost for being responsible. And in the session that José Manuel Capa ran this afternoon, you heard, I thought, from Yolanda too, that view that said, look, in the long term, exactly as you say, it's definitely the interests of both investors and the companies they invest in that they are responsible, that sustainability agenda. But there will be times where you feel as though you're out ahead and that responsibility is not rewarded by the markets. How do you marry that financial pressure, that pressure from the shareholders, and the social agenda?
I haven't seen the shareholders putting pressure. I didn't get this impression, putting pressure on Santander management. I've been here 16 years facing shareholders for having next quarter very good results.
Yes.
So they are asking us for consistency, predictability of our results, our capacity to generate results. I never seen this contradiction in Santander between short-term goals and long-term goals. So we build on loyalty. And to build on loyalty means that I'm not building in loyalty for the next quarter, I'm building in loyalty for the next 10 or 15 years or 20 years with the customer base we have and the ones we want to keep increasing. Yeah? So there is now a shortcut that you can do in a quarter and to be extremely successful in one quarter and next quarter. No, this is not the way the industry works. Investors are smart people, very smart. Yeah. And they know when a company is doing the right things for the long run, and yes, when the company is just doing a quarter or 2 quarters in a very good shape. We are the third most sustainable bank in the world, yes, and the first most sustainable in Europe. And you look at the track record of this company in the last 15, 20 years, when we ask everything, we've been the most predictable bank in terms of generating results, because our diversification is true, but also because the way we look at the business, retail banking business, that at the end is not to do a deal. I'm not doing a deal. We do thousands of deals a day with thousands of customers all around the world, with 140 million customers. We do deals on a daily basis, very small deals, very important. Each one of these deals is extremely important for the person or the company that is doing the deal. And what we try to do is to profit from those deals in a fair way. As simple as that.
Okay, well, I think that seems like a good note to end on, because if we're interested in loyalty, you in the audience have been extremely loyal. You've stuck with us all day, and I want to say thank you to you for being part of this, making this conference happen. As Alejandra said, one of the things that we're trying to do in setting up Tortoise and in the partnership with Santander is to try and create systems where we listen, and we listen in an organized way. And so I'm going to just try and pull together, if I might, just a brief summary of what we've heard, so that we can then get a cup of coffee and maybe even a bite to eat. And I think the thing that we've heard today, alongside, I should say, not one but two masterclasses in political thinking and political leadership, has been a recurrent theme, which is not necessarily simply about responsibility or about technology, but about trust. This word that came back time and time again was about trust. And I thought there was a moment in George Bridges' session where Nairi Wood says, this is not about technology, but to paraphrase, it's about trust. Daniel Calleja said the same thing. A responsible bank is a bank you can trust. John Hope Bryant said the same thing. He said, banks are not always the best at marketing. They need to make clear that it's not necessarily a technology or even an institution. It's human. It's about an individual, a person you can trust. And of course, the risk with an agenda like that is we end up saying things that feel very motherhood and apple pie. They feel very predictable and true. But happily, we had a to-do list, I think, of about 6 points. And so I think in concrete terms, we talked about building trust in 6 ways. First, there was a serious conversation about data. Jimmy Wales kicked it off talking about how do you create systems where people trust the mechanisms whereby their data is held, and that's non-trivial. We need to be more transparent about it. It was interesting that in George Bridges' session, actually, when you looked at the concern that people had about financial institutions and trust, the biggest of all, 79% in policymaking circles, was security of data. And you have to think that this issue that also came up in George's slides, this idea that you can have a £1 trillion cost of cybercrime and rising, and ask yourself whether or not that you can have that level of insecurity and for it to be sustainable. It was Lindsay Argalas' session, if you like, that focused most on what you actually do about it, how you actually provide for consumers, what George later called, how do you do the basics brilliantly. It struck me that Roberto Viola and Bernardo González Rosas provided 2 arguments about how regulators address that. So Roberto Viola talked about how do you encourage competition, how do you make sure there's more than just one bus on the road, and that will provide consumers greater options and greater opportunities, therefore, for trust. Bernardo González Rosas' approach was how are we going to mitigate the risks? We have the capacity to do so. And going back to the very first session this morning, Imran Ghulam Hussainwalla's approach on open banking was fundamentally about transferring ownership of data, that open banking was going to give data to the individuals. So there was a to-do list around trust and data. There was, as Jose Antonio just said, I think a recurrent theme about responsibility in a totally different context, financial inclusion. And it was the point that Nadia Calvino made at the start of the day, that financial inclusion is obviously high up on the agenda of this government. And it was made, I think, in the story that Anna told about how you could simply give someone a credit card and how she would feel, the woman in Mexico that Anna had met, suddenly part of the financial system and the world. It struck me that Michael Schlein's very good point was if you want to ask whether you're a responsible bank, ask yourself first, who are you banking to? And if you're not banking to the 3 billion people who are outside the financial system, then there's probably a question of responsibility to answer. John Hope Bryant put it very simply that there are 1 billion people for whom that is low-hanging fruit, where their credit scores could so easily be moved, they could cross the line from excluded in the banking from the banking system to included in it. It struck me that the third area on the to-do list, though, was about governance and reward. Again, Nairi Woods, I thought, made a very pithy point, which was governance is needed to make sure we know who's in charge. And banks know who's in charge when it comes to bonus time. Do they know who's in charge when things go wrong? And that's the responsibility of governance to deal with that. It's also essential that we have a greater alignment of these social goals and the financial ones. And, you know, notwithstanding what Jose Antonio just said, it felt as though there was a tension through the day of what are investors looking for when they're looking at financial services stocks, and what's the agenda in terms of meeting the new requirements, particularly around environment, society, and governance. One of my favorite moments was actually when Jose Manuel Campa said to Yolanda Cortines, responsibility, does it pay? And there was a pause, and a suggestion was, yes, it does, but it does over time. Clearly, we're going to have to innovate in our systems in order to make sure that Europe in that regard is a laboratory and not a museum. On ESG, apart from the fact that I would just like to point out that no one outside the financial services industry knows what ESG is, if you want to make ESG work, clearly there is a big question about having an agreed set of data. It was quite striking to me that Hugh Van Steenis, who was the one who made the point that virtue has a price, was making the point that these mechanisms can change behavior. They can change behavior of the worst, but they can also improve and force improvement year on year, and he chose the model of the gender pay gap. That has made a real difference. You'd have to worry, listening to Daniel or to any of the others during the course of the day, that agreement on that data is going to be a long time coming. And then I think there were two final points. One was about trust within the system. It was the point that Anna Botín kicked off with about asymmetric obligations. The idea that you can have one set of rules for one industry and one set of rules for another industry, even though they're fundamentally providing the same service. And even more tellingly at the moment, one system of taxation and another system of taxation. That seems to me to go to the fundamental question of trust within the business community, within the system itself. And if the changes are going to be made, Roberto Viola was very clear that changes need to be made, that needs to be made soon. But then the final point I'd like to make is that the thing that was most striking was through the course of the day, we were discussing business and technology, but hovering over it all was politics. And I thought Nairi Woods' point that we were thinking here about not just technological disruption, but social disruption was particularly significant. And that is going to have an impact on anyone in business, you know, given the points that she made about the enthusiasm for nationalization, the enthusiasm for taking public ownership even of banks, how far and how fast that has changed. And the sense that people don't trust the rules that are being made and don't feel they have a handle on the system by which those rules are made. And that all of us have a responsibility to change the way in we operate from being top-down to being much more horizontal. John Hope's phrase was, we have culture in the economy, not economy in the culture. And that relates surely to the trust in our open democracy systems. Which takes me finally to the points that were made so incredibly powerfully by those extraordinary men, Felipe González and Fernando Henrique Cardoso. It's an embarrassment for all of us, I think, that we stand here, or at least I now sit here, reading from notes. Those two gentlemen gave a masterclass without a single note between them. But the thing that was most impressive in some ways was this connection between trust, our politics, and the confidence that will take us forward. How do we move from a Europe that is not a museum, but remains a laboratory for innovation and new ideas? How do we ensure a Europe that tackles the problems, or a Brazil that tackles the problems of corruption or of crime? How do we articulate policies that sorely need to be articulated? And how do we do so in a way that's not backward-looking, that doesn't give a leg up to what Fernando Henrique Cardoso called the low clergy, that is not backward-looking and engaged in regressive utopias, but forward-looking? There were two wonderful phrases, I thought, that the former president of Brazil gave us. He said, the most important thing that we need is confidence. And he also said that I'm not very good at social media, at my age, but I'm trying. I'm sure all of us feel the same way. And on that note, I hope you'll join me in thanking David Wright, in thanking José Antonio Alvarez, and most importantly, please, in thanking Alejandra, who's done all the work in putting this extraordinary day together. Thank you very much indeed.
Thank you, James.
Thank you.
Well done. Thank you very much. This concludes our conference this year. I hope you enjoyed it. We certainly did. We want your feedback. Please don't forget to fill in your survey when you get it on the email this afternoon, hopefully. Thanks to the team that made this possible. Many of you are around. It's been hard work during months. And please join us now for a networking coffee outside. We've deserved it. Thank you very much. Thank you. Thank you, Joe.